Welcome to DIY Finance Hack. My name is Eddie, and I work in corporate and a passionate part time investor. I started investing in properties from 2009, and 2 years later, I started investing in individual stocks, then high dividend paying stocks, NLIC, before I discover ETFs. I'm here to share my investing experiences, ideas, and mistakes to make you wealthy with some fun. You'll see some of my videos featuring my pets, favorite places, and things to do. In today's video, I will go through how to construct a winning investment portfolio consists of ETFs and individual stocks with an example. I'll go through my top ETFs and individual shares for you to do your own research and for you to consider. I have a pie chart here with an example portfolio consists of ETFs and individual stocks. If you want to learn more about ETFs and why we should invest in ETF, have a look at my other videos. So in this example, I've got 40% ETF on an index fund, 20% on international ETF, 20% Australian ETF, 10% growth ETF, and 10% consists of individual stocks. You can play around with percentages. So if you want more growth, more risk, you increase your growth ETF or you increase your individual stocks. There is no right or wrong when it comes to constructing a portfolio. If you're about to retire and you want to take less risk, then you want to have a bit more of the Australian ETF. You don't have to have international ETF if you don't want to, so you can get rid of it. And now, the idea here is to beat the index. For example, IVV that invests in the S&P 500 returns around about 15% per annum um, over a 5 years period. So the idea here is with your international ETF, your growth ETF, and your individual stocks, you want to beat that 15% per annum. An Australian ETF gives us great income in the form of dividends and also franking credits. So we're very lucky to live in Australia. In my opinion, you don't need to invest in bonds or real estate ETF. Just simplify your shares portfolio by having Australian ETF instead. I provided some example here of some of the ETF that I like. So index fund IVV, they invest in the S&P 500 index. International ETF Qual, QUAL, they invest in quality companies. Australian ETF VHY, they invest in Australian companies that pays good dividends. And a growth ETF NDQ. I love NDQ because it invests in the US top 100 tech companies. Companies that we all use. For example, Google, Microsoft, Nvidia. Once you've done your research and you know which ETF you want to buy, which individual stocks you want to purchase, accumulate enough money. Once you have that saving set aside, have a look at how the market is going. My suggestion is every quarter there would be a dip in the market or a correction in the market. That's when you put in some of your savings into the market. So this is called dollar cost average. So you don't want to put your entire saving all on the same day. You want to progressively during a dip or during a correction, during those 2 weeks period where there is a little bit of a dip, you put some money in. 2 days later, put a bit more and also purchase different ETF until you construct your portfolio. What happens when your growth ETF becomes a lot more than 10%, which is great. That's what you want. My suggestion is rather than selling your growth ETF and purchase more of the index fund, as an example, just let it grow and top up your index fund instead. That's called rebalancing. And obviously, it's up to you if you want to sell your ETF to purchase something, it's all up to you. This is the best part, this is the fun part where you research and figure out which ETFs you want to own. These are just some of my top Australian ETFs. I explain each one of them in my other videos so you can check them out. Let's have a look at all of these: IOO, VGS, MODE, Qual, IBV, VTS, NDQ, VHY, and VAS. These are their return per annum over 5 years period. NDQ comes on top, 20% per annum return over 5 years period. And if you can see all of them, all the international ETFs, US ETFs, their return is around about 15% or more. With Australian ETF, VHY, and VES, it returns around about the 8-9% mark. However, the Australian ETF is great for dividends and it also a lot more stable than international or the US ETF. I want to go through some of the popular individual stocks, individual Australian companies. So this is their total return over 5 years period. So total return. I know it's a bit difficult to say, but I will go through them. So IVV with the red arrow there, it returns around about 100% over 5 years period. Now starting from the bottom, if you look at CSL, a popular Australian company, it hasn't gone anywhere in the past 5 years. Next up is Macquarie Group. Not too bad, it's 66.44%. Next up is CBA, 89.11%. Next one is IBV, it returns almost 100%. Next one is REA, very good. It beats IBV, 135.25%. And car sales, CAR, very good as well. It beats IVV, it beats REA at 161.54%. I want to show this chart because although there are Australian companies that can beat IVV, so clearly CAR and REA, realestate.com, beats IVV. But there are a lot more Australian companies that can't even beat IVV. You can check it for yourself. Have a look at your favorite companies like Coles, Woolies, Peltra, Rio Tinto, BHP. Have a look and see whether or not they can beat IVV. I want to conclude by saying investing doesn't have to be complex. Have some ETFs to construct your portfolio. You don't have to have individual stocks. Keep adding your savings to your portfolio and watch it grow over time. And we are talking about long term here, long term investment over 10 years. Thanks for watching. Please do your own research and happy investing.